I said, hey, sweetheart, I'll be back, I think Wednesday or Thursday. And then she said, do not come back until there's a plan to break even.
Nice. I am so excited for this. Kaz, from CEO of Shopify to now CEO at Opendoor.
I never thought I would leave Shopify. I thought it was going to be like my job forever. If we can make buying, selling, and owning a home easier, less frictionful, the world will be a better place. We will get to a point where you will buy a home from Opendoor, and if you don't like it, you'll be able to return it. Businesses should not exist to make money. Businesses should make money to deliver on a mission. Corporate executives should basically only get paid in options. It's a very weird world where we create an incentive for corporate executives to be bad at their jobs just to get paid. Opendoor is priced in the public market for its potential, and it's an incredibly fair price for the potential. The bull case for Opendoor is obscene. It's hard to exaggerate how big this company can be. I don't optimize my life for money. I just don't. When my wife and I got married, we agreed we would optimize our life for living a dent on the world. Having said that,
Ready to go? Guys, I am so excited for this. You all know it's my favorite time of the week. My mother even loves these shows now, which I think is incredibly heartwarming because she listens to everyone. But we're going to start on news item number 1, which is Kaz, from CEO of Shopify to now CEO at Opendoor. Kaz, first, thank you so much for joining for this first little stint.
thanks for having me. I appreciate it, man.
Now, I wanted to start with the question, you left a great and huge business in Shopify. You must have the ultimate conviction that iBuying is a good business. Can I be so blunt as to ask what led that conviction when it's been a challenged conviction to have over the last few years?
Yeah. I mean, look, I never thought I would leave Shopify. I thought it was going to be like my job forever. And I just genuinely loved the company, loved Toby, love what it stands for. But when I joined Shopify, everyone was like, what the hell are you doing? This is a tiny company. It's going to go nowhere. It was among the most shorted stock in the tech market. It was like very much like, this thing will fail. In fact, it was like a very lot. Like I think Citron wrote in a short report the day I joined Shopify about how terrible business it was and how it wouldn't last 2 years. But I think Shopify is a wonderful company. But look, I think the fundamental problem that Opendoor will solve is an incredibly important problem, not just as a business, but for the world. Like, if we can make buying, selling, and owning a home easier, less frictionful, less terrible, the world will be a better place. We will figure out how to make money along the way. This will be a great business. Like, we will make money. This will be a great business. But the problem space is a valuable one to explore. And I think you need to do it unapologetically. Like, the goal here isn't to minimize risk. We have a mission to go after. We'll go after it incredibly aggressively. And we're going to make it easier for both people who are buying and selling homes to engage in that transaction because it matters to the future of our society.
Can I be so bold and just ask, does that not feel like a bit of a boom time mindset? Oh, it's a valuable problem and we'll figure out how to make money along the way.
Fuck no. No, definitely not. Look, this is not, like, I'm not saying we're going to figure out how to make money along the way. We will make money. That's not what I'm saying. Like, we have plans on making, like, we will have plans to make money. We have like some couple of good bets already. We'll launch more of them. I'm not saying I have like a hope and a dream of profitability. This is a for-profit company. Like, it's very much a for-profit company. We'll figure it out. But what I'm saying is that businesses should not exist to make money. Businesses should make money to deliver on a mission. And those are important things. This is we are a mission-driven company and we'll make a profit such that we can deliver on our mission. And like, the shareholders will be happy, buyers will be happy, and sellers will be happy. But that's the goal. Like, I'm not saying like, oh, I don't know how to make money. I know how to make money here. What I'm saying is the mission is more important than the money.
A wildly successful software executive, how do you deal with like this meme stock element to the company? Like, I'm not a meme stock guy. I don't trade. Yeah. I'm long in everything. This isn't GameStop, but it's crazy. This meme-ishness pre-you is crazy, isn't it?
Yeah, look, I'm not a trader. I owned literally one ticker. When I was at Shopify, it was Shopify. I expect I will own 2 tickers for like the next little while. Shopify and Open. Like, I'm not I'm not a diversified trader guy. That's not what I do. That's not my job. My job is to build great products and get people to pay for them. Let's back up. The second thing is I actually fundamentally reject a premise. Like Opendoor is priced in the public market for its potential. And it's an incredibly fair price for the potential. And I think we will earn that right to actually be like, we will earn the potential. We're going to go execute against the potential. That's not that different on how startups are valued by VCs. You don't value the current cash flow of a company. You value the potential and say, what are the odds it will get there? Right? That's what you do. You say, what's the discounted cash flow odds of this thing being big? And I think if you do it that way, this is the single largest market in the world, right? I think Tesla was not above 10% in any market it was selling cars in. It made until last year. It is above 10% in some markets this year. Opendoor was above 10% in many markets it was selling homes in a couple years ago. Like we will get back there. It's a significantly bigger market, significantly higher attach opportunity, significantly longer ability to have a relationship with the buyer and the seller. So if you assume that, like if you just do a rational, by the way, I'm a math nerd, right? I was a mathlete growing up. I live like I'm not a word cell. If you do the math on the potential of the company and just discount it back, I think the stock is like reasonably priced. I would have bought at this price. In fact, I did buy at a higher price than the current price.
Bunch of different things. One is I think totally agree. I think the meme stock thing is actually two parts to it. There's the, price relative to value. And then there's obviously I think it's a combination of meme stock and activism. I think the interesting thing here is a set of investors from outside have been able to agitate and drive change. In this case, I think very interesting and good change, but it's kind of like, this is what the evil activists would be like if they were VCs. And it was just kind of fun from a distance to watch it, just rattling the cages of the board and saying, you need to do something different. And eventually the board said, hell, you're right. Let's do something different. Let's call Kaz and put these other guys back on the board. So that's an interesting thing.
I think you're absolutely right. Look, I think there's the bull case for Opendoor is obscene. Just obscene. Like it's hard to exaggerate how big this company can be. But companies require good stewardship and operational excellence and aggressive execution, right? There are companies that can be run by professional managers. Like if you're a widget factory, professional managers are great for you. If you're a software factory, professional managers are the death, right? Like I'm no one's idea of a professional manager. Not that dude. So like we're going to create alpha.
Are you a software factory though? But like you have a lot of real assets on your books. You have a lot of illiquid assets on your books. This is a very real world financial mechanics business in a lot of ways. Mm-hmm. It's not a software factory.
I disagree. I fundamentally disagree. Like Opendoor is a software company that happens to have some assets. I think there's an asset light model here that could work incredibly well. There's an asset heavy model that can work incredibly well, and we'll have like literally all of them. I fundamentally think you must judge companies based on where leverage comes from. Like you look at a company like, that's where leverage comes from. The leverage from Opendoor will come from software. We will build excellent software products for buyers and sellers of home and owners of homes. And we will attach services to those products.
And one level down, because on that, do you think that excellence, because there's two things you do. You have to be able to predict the price of an asset. Well, maybe three. You've got to have a kind of top of funnel to drive in buyers and sellers. You got to have a really big AI brain to figure out what these assets are worth. And then you got to have transactional efficiency to make all the shit happen, like the processing, the selling, the repairs, all that. How do you think, and maybe those three things are what you're calling the software factory. Which do you think is the hardest part? Which do you think is the most important part?
So I think the last part is very software enabled. And generally I am 24 hours and 12 minutes into the job. I'm generally impressed by the last part of the business already. It could be significantly more software enabled, significantly more AI enabled, but like I'm actually generally impressed. But I think like the long-term leverage for this company becomes offering a fair price for home, not trying to make all your money on buying homes at a discount. That's just like no one wants to have selling a home for a fair price and adding value-added services on top of it, right? Adding things that homeowners and home sellers want as a part of that transaction. And you've earned the trust because the price is fair, the house is good, it's valuable. You're not selling lemons. Like you're offering, hey, like we will get to a point where you will buy a home from Opendoor. I'm not saying tomorrow, but you will be able to buy a home from Opendoor. And if you don't like it, you'll be able to return it. We'll get to that point. We'll get to a point where you'll be able to buy a home from Opendoor and we'll stand behind it for the life of that house. And you'll be able to treat it as though it's a guaranteed asset that we will take care of and take care of you as a buyer of that house. As a seller of that home, we'll be able to get to a point where we will find you a new home. Like you don't have one? Great, we'll find you a new one. Like we will find a way to make the liquidity work in the long run, and we'll focus on both buyers and sellers. For what it's worth, this isn't uncharted territories in the public markets. Carvana has a very good model of this, where they offer a fair price to buyer, fair price on the seller, make margin on added services.
Well, first of all, I'll make big picture comment. I think this is one of the hardest business models out there. I think, and that's it's just like, I totally see the upside, but truly, we look not at Opendoor, but some of the others. This is one of the most challenging problems I can imagine, right? Because, you made the Carvana analogy, and it's fair. I mean, as people know, Carvana was another high flyer in 2021, plummeted in selling cars, doing the same thing for cars, plummeted in 2022. Investors, including Thrive, bought some more, stocks up well north of 10x. Everyone looks really smart who held and bought. And obviously, if I was you, that is the mental model I'd be pushing all day, every day, right? But the one of my many nagging worries on this is, it's easier to price a car than a house, right? The nuance you have to get right. I would wonder, prove me wrong, you can get within 7, 8, 9% pretty accurately on comps, but it's the little shit that when you walk around the house, they have an X, that garden's nice. It seems to me the last 8% of price, which is where you make all your margin, has a lot of variety. And I could be wrong, but that seems to me the hard part of price.
Rory, I think you are wrong.
Cool.
I think you were right.
Yeah.
I think you were right 3 years ago.
Yeah.
I think 3 years ago, this was an incredibly difficult problem that required human beings to visit homes and look around and look at the shape of the garden. Like that's a real thing. If you're one side of the street that has a slope, the other side doesn't have the slope, those two things are priced differently. But there's a reason why God invented AI.
Yeah.
This is a solvable problem today. Like we don't need to limit ourselves to what human beings can see.
Agreed.
Like this is a real thing. Human beings are variance creating machines. We can build software systems to solve these problems. You know what the funny thing is? Shopify is notoriously a bad business. It's a high churn business selling to small businesses at a massive discount.
Totally.
Look, I made this decision. You could buy Shopify for $1. $1. It's a SaaS product you can buy for $1. Right? There are no seats. There's no seat expansion. Shopify is the best deal in SaaS. When you buy a software, it's the best deal in SaaS. Shopify, we make our money when you succeed, i.e. from services at Shopify. Opendoor will be the best deal in buying and selling homes. And we will make our money by adding value to those homes in ways that other people cannot do because they don't understand a home, they don't understand to buy, they can't underwrite the risk, they can't provide additional services. The problem with having to make all your money in one transaction
Agreed.
is that you by necessity have to be shady.
Correct.
Right?
No.
This is why people sell used cars aren't awesome people typically because they have to make all their money in that 1/2 an hour. Whereas if you make your money in the long run from a long lasting relationship with the counterparty, you have an incentive to do right by each other. And this is actually a key differentiator what we will do. We will create a network for buyers and sellers, homeowners, home buyers, and home sellers, where they will have a long-term relationship with us over a series of products we will launch. Some of them will be free just because they're good. Some of them will not be, and we'll make money on them.
And totally, I mean, you're exactly, title, mortgage, there's a whole bunch of things that happen right there that are wildly profitable on top. I mean, title insurance is the world's best business because no one ever pays out a claim, right? So I totally get that. How do you think about the role of the estate agent in this? Because that role is changing also. And obviously it's 6% in a world where you're making 8%? How do you think about how estate agents fit in?
Look, I think there's a structural issue that we need to think through, which is this. Transactions and relationships that have many intermediaries are typically not great ones. Like, it's just not awesome transactions usually. Like, you usually want to look the person you're dealing with in the eye and deal with them. Right? That's what the real thing is. Now, do I think there's a place for experts to help either side? Yes, in some cases, but not in all cases. In some cases, you will. So I'm not dogmatic about this.
Okay.
But I do insist on an excellent fucking product. Like an excellent product that a buyer and seller can use and be proud of. Now, if some set of those buyers and sellers want to have someone else help them, great. I'm fine. I helped my mom set up her Amazon Prime account. Like, it was fine. She didn't get a worse experience from Amazon because of that. But we will provide an excellent service to buyers and sellers. And if in some cases we will have other people involved, and that's fine.
Cool.
Yeah, it's that I didn't really fully get the Shopify analogy just then, but Shopify is only 25% of its revenue from software and going down, right? It is the cheapest. It's one of the best deals out there, right? I mean, maybe ChatGPT is a better deal, but they've got to you had to earn the other 75% through merchant services and others. You had to earn it.
In 3 years' time, will you have more of an asset light model, or will you more be an asset heavy model? And do you have?
I mean, the company doesn't have an asset light model right now, so yes, by definition, yes.
Well,
yes.
No, but you can choose to stay. You can choose to stay in asset heavy, or you can choose to transition to asset light.
We will not choose to stay in that and solely asset heavy world. Like, I'm not. Look, guys, I'm not publicly traded company, etc. But I don't have a magic plan that I'm executing against right now. This is 24 hours and 19 minutes now, but we are going.
You had 7 more minutes, Kaz. Come on,
and the last 19 has been wasted. He's mentally saying to himself, "But keep going, Kaz."
I think what you need to do is look at the problem space and solve all of it for the user. You need to look at the problem space and solve all of it. It's incredibly hard to build good products. Therefore, it is incredibly hard to build good businesses if you're solving the tiniest problem that you happen to think is profitable. By the way, if you do that, you end up with adverse selection. The market eventually clears properly. And if you think for a very long time, you're going to have 20% margin buying homes cheaper than someone else, you're just straight up dumb. Like, the market eventually clears appropriately. What you need to do is be incredibly efficient on the first transaction and incredibly valuable on every transaction thereafter. And that's our job here. And we're going to get there. Like, it's going to take us a second. We're going to screw a bunch of things up. We're not going to be perfect. We're going to launch things that won't work, but we're going to start fucking launching things.
Kaz, how did the comp discussion go? You know, it's quite notable that you aren't taking a salary pretty much, or like $1 or whatever it is.
I would take less. I'm not allowed to. I'm not allowed to take less than $1. I would gladly take less than $1.
So when you hit $30, you get remunerated a lot of money.
Can I tell you, yeah. I think if I could make it the following way, I would have made it the following way. I think corporate executives should basically only get paid in options. I think it's a very weird world where we create an incentive for corporate executives to be bad at their jobs just to get paid. I think it's just so fucking weird. Where, like, the thing you have created is be inoffensive enough not to get fired. That's very weird. I would have gladly just clicked. I own no RSUs. Zero. Like, actually zero. Literally entirety of my performance money is based on the stock price going up, and like there's different cliffs. Some of it is like a phantom option where if the stock price goes down, it's worth zero. Some of it vests based on price. Like, this is complicated because of very odd like Delaware and SEC rules, but I would have gladly taken just options. In fact, that was my preferred state. But we have tried to construct a thing that looks like just options with some ups, like some vesting over time with stock price. But look, I don't have Yahoo Finance on my laptop. I will not look at the stock price every day. What I will look at is delivering value for users and shareholders of this company over a long period of time. And that's what we're going to do. Like, I think this company is incredibly valuable. I think like you are. I thought when I joined Shopify that the market misunderstood the opportunity. I think the market massively misunderstands the opportunity for Opendoor, just like by order of magnitude.
Kaz, how important do you feel it is that you have Keith and you have Eric coming back into the fray as well? That's another.
Would not have taken the job without them. Like straight up wouldn't have done it. In fact, I said I won't do it without them.
I love that.
Like we're not, look, we're going to do things that look odd, but what they look isn't important. What they are is important. Like how things look is less important than what things are. And we need people who will be with us while we take those risks.
I think that's super interesting. And it actually gets to the whole private versus public thing, right? And there was a super article in the New York Times recently on basically why being public is a pain in the butt, right? And I think you're exactly right, Kat. This is a refounding of the company. And if you didn't have that air cover from those guys coming on, it's just really hard for a standard corporate board of a public company to do the kind of pain you're going to see in the next 12 months to turn this thing around, right? So I would agree with you. I think that if I was advising someone as a CEO to take this on, your first question should be, where is your air cover from entrepreneurial people, not the kind of people you find doing a public board for 200 grand, who will allow you do this? Because if you don't have that, invariably you're like the poor guy at Intel. You have this big ambitious plan. You tell everyone on the board you have this big ambitious plan. They all agree. And then 1 year in, it's like, oh my God, it's terrifying. We're out of here. Right? So I think you're exactly right. And it's a rare combination to be able to I won't say fix, to orient the board around the task at hand.
Yeah, dude, I'm not like, this is a very, we have great board members, but I view them as colleagues and coaches.
Yeah.
There's a board member who's coming into the office in a couple of hours because we're going to go through literally every house we own line by line together. With that board member, we're going to sit next to me. We're going to go through everything. One of the first things I did was I got a board member and I went through literally every invoice the company had paid for the last 12 months. Like actually every single one of them. Like I reviewed like every line item. Our board members are going to join us along this mission and they're going to work as hard as we do. I'm like incredibly excited.
Do you want Shamath to come back into the fray?
Dude, the world can't have enough Canadians, man. Like it's just a real thing.
The man wins, Kaz wins. That was a killer answer.
It was good. He's well trained. Final one from me, and then we'll let you go. When you made the decision, you have a huge amount on the table at Shopify, and you left that for this.
Yeah.
How big is this?
$100 million.
A few $100 million, exactly. Yeah. You believe that you will make more here, and what is that upside here when you did that evaluation?
I mean, look, I don't optimize my life for money. I just don't. I optimize, when my wife and I got married, we agreed we would optimize our life for leaving a dent on the world. Like we will leave a dent on the world and that's what we optimize our lives for. Having said that, I'm incredibly bullish on the bet. I would not have taken it if I didn't think it was going to pay off. I'm very, very bullish on the stock. I'm very bullish on the company. I think we will build, and this is my ask of everyone who has bought the stock and is cheering us on. We will build a generational company here, and they must hold us to account for doing that. Like we must do both things. We must build a company that makes the world a better place, and we must deliver shareholder value. And both of those things are incredibly important. And I'm asking people who have bought this stock in hope that we will do the right thing to hold us to account and call us out when we don't do the right thing.
Look, I mean, this man has put his money where his mouth is, and that's pretty damn impressive. I mean, you really have. Well, I mean, look, you've walked away from a exciting, challenging, extraordinarily well-paid, very manageable, safe gig to double down on, as I say, it's a truly challenging problem. So it will be fun to watch you figure it out.
I optimize my life. At the end of every week, I write down a note to myself. Was the week hard? Was it valuable? Was it fun? At the end of every week, I judge my week based on hard, valuable, fun. That's a goal. Every week to have all three. I find that you can't have fun unless you have the first two. I had my first all hands yesterday in the company. I told the team that we would value this company's next year over hard, valuable, fun. I don't know where the offices will be. We're going to figure that out this week. We'll announce them to the company on Monday and to the world on Monday. Opendoor will be the most aggressive in-office public tech company. If you are a builder, if you want to build a future that is better for homeowners, that tilts the world towards owners rather than renters, find us. We're going to build an exceptional team and ship exceptionally fast. My DMs are open. Send me a DM. I don't know where the offices will be. I will know on Monday. but we'll figure it out.
Kaz, you are a hero, man. Thank you so much for doing this on your second day. You are a hero.
Thanks, guys. Thanks, guys. Have a great day.
Back to work. Good job.
Back to work.
Thanks,
Bye,
guys.
dude. Have fun. We're going to go back to normal programming, baby. And I want to start with Oracle and OpenAI. Oracle touching $1 trillion. Rory, you're always quite good at setting the scene, and I actually got given some good feedback the other day, which is we need to set the scene for the stories. People love the analysis, but they like to know actually what happened. Can you just help set the scene of Oracle, OpenAI, what happened?
I think it is good feedback. We often do forget, we dive right in. So step back. What happened is Oracle announced, I want to say that whatever was Q2 results, they have an off year, they have an off cycle year, so it might have been Q1. And for what it's worth, they were actually a little light on the quarter's results. But they announced a future RPO revenue performance obligation of north of $300 billion. In other words, they said in the future, we've got orders as of now that we have to deliver in the future for well north of $300 billion. Most, and they didn't say this, but you figured out, but most of which is a big OpenAI order for around $300 billion of future cloud compute for their AI platform. And the stock exploded. The stock went up 38%, I think briefly making Larry Ellison the richest man in the world. Yay, Larry. And Oracle touched $1 trillion. So a total, I mean, it's unparalleled for a company, a top 10 company to jump by 38% in one quarter. So a huge jump. Since then, some skeptical commentary, but that's what happened.
How did we analyze it then subsequently? How did you feel when you read it? Because as you said, there were skeptics. How did you feel?
I suppose a little skeptical. I mean, positive spin. If you believe the revenue, $300 billion, let's just say, if you think OpenAI has $300 billion to spend, plans to spend it with Oracle, and does in fact spend it over 5 years, that's $60 billion of revenue a year, divided by 5. So even at a 5 or 6 times revenue multiple, that gets you to $300 billion in delta market cap, which is exactly what happened. So if it's 100% money good, and, you can say it's some kind of recurring revenue thereafter, then it kind of roughly corresponds to the increase in value. It's just that then you say to yourself slowly, the customer promising to give you $300 billion is doing $12 billion in revenue, has raised, $40 billion total life to date, is still losing significant money, and therefore is going to have to raise, as Sam Altman has said, a couple of $100 billion, he said 115, but who's counting, to be able to pay you that money. So you look at it and you go, this is a very levered bet on everything at OpenAI working. So to some extent, it's kind of like a proxy OpenAI stock. It's like, I can't buy OpenAI in the public markets. So if OpenAI is successful, it will have $300 billion. If it has $300 billion, it will give it to Mr. Ellison. If you give it to Mr. Ellison, the stock will go up by Oracle, right? It feels non-risk adjusted. It feels plausible, but non-risk adjusted. You're applying 100% certainty to 2 or 3 things, each of which have a fair amount of uncertainty associated with it. That was my kind of net takeaway.
My real question was, have any of us given up caring whether any of this revenue is profitable? I think the bet that OpenAI can come up with the money is a reasonable one. They may not, right? There's some risk there. But so far, Sam has found a way, right? I believe that, I mean, Jesus Christ, CoreWeave and everybody these days said they have insatiable demand. So that's okay. But no one cares that this adds nothing to Oracle's bottom line and may never. No one cares that Oracle is basically a fungible set of server services for folks that don't want to bother to bring it in house. I mean, this is a for the foreseeable future a zero net margin business for them, isn't it? No one cares. Just no one. It's good for VCs. Like, we don't have to look beyond the top line. It makes our lives much easier. We don't have to worry about these silly things like inference costs and gross margins because the public markets don't care anymore.
Well, you are right. From the perspective of, say, 5 or 10 years from now, the people selling cloud computing to the people who own the models will probably not make as much money as the people who own the models. That's a pretty obvious statement, right? Even though OpenAI is losing a lot of money now, being a commodity provider of services to them exudes over the medium term being a more commoditized, less profitable business. So at some level, you agree, is that I prefer to own the model company than I prefer to own OpenAI than CoreWeave. And to the extent that this is just CoreWeave 2, you're totally right, Jason. Now, the fun thing is we are dealing with the man who most successfully on the planet extracts operating margin from software companies, which is Larry Ellison. And, that's why he owns 41% of this damn thing, up from, 27% a decade and a half ago, right? Just getting that free cash flow and recycling it back. But you're right. This does feel like getting 300 billion in revenue. And to your point, Jason, in return for which you have to spend a whole buttload up front on CapEx in return for a business that however profitable it will be, and maybe it is profitable, it won't be as profitable as the 41% operating margins that they currently get from selling databases. So I agree. Even after the revenue,
nothing today, isn't it? I mean, literally, this business is consuming cash.
I'm sure. Well,
right?
Yes, and
yeah,
yes, and I'm trying to recollect. And you probably have some kind of positive accounting gross margins, but really it's all about the assumptions you're making on your CapEx depreciation. And if you know over how many years you should depreciate the latest NVIDIA chip, then that would be the key question. But you're right. Is that on a cash flow?
This isn't a bunch of memers getting excited about CoreWeave. This is Oracle. This is a company founded in the 70s where the public markets are like, we don't care that your new GPU hosting product, which has massive top line growth, right? We don't care at all that it's contributing nothing to the bottom line. We don't care. We don't care even an iota is what the public market said, didn't they?
Agreed. No, you're right. It is, Jason, you're exactly right. Is that just like, I think it's equivalent, but with more success than the Facebook/Meta story. You have an existing business. It's freaking awesome. It's nothing to do with AI. It kicks off 41% operating margins for Oracle, high 30s, 40s for Facebook. And the market is saying to you, if you got all that free cash flow, have at it, big guy. Throw it back in, see how it goes, right? And, in the case of Meta, they're not penalizing him. And in the case of Oracle, they're actually rewarding him for doubling down on unprofitable growth. So entirely rationally, he's doing it, right? And it's got to...
Is this not that...
Great. One last thing. It's got to feel freaking great when you've been cranking like that guy has for 50 plus years. Whatever it makes long term for the stock, the fact that you sprinted ahead and for a brief shining moment, the richest man in the world, probably that alone is worth whatever future damage you've done to your operating margins. It's great.
Is this not an ultimate sign, though, of where public market irrationality and exuberance is? That Sam Altman in this announcement says that with the margins associated to this order, and it jumps 38% at this scale, is that not the height of irrationality?
You mean unlike us sober, careful, and sober-minded private market VCs? Yeah, I'm shocked to discover gambling going on in the stock market, Harry. Yeah, it's pretty frothy. And I think you're dealing with, look, there's been froth in the private market for AI for 2 or 3 years. And probably the public market is saying, I'd like to get in on the game. And this is one of the few ways to play it. So I agree. It's frothy. Is it more frothy than any of the things you're seeing or I'm seeing? I don't know. Who am I to judge?
The one thing I do think is important, we mentioned the margin element. I have never before seen such lack of investor diligence on anything except top line revenue growth. Ever. Astonishing, where it's not included in updates, hundreds of millions of dollars wired without a discussion on margin. Number one. And then number two, it's just like growth is amazing until it doesn't grow anymore. And when you look at this, for OpenAI to pay this, if they 2x between now and July 26, and then 2x again between July 26 and 2027, they'll be at 48 billion and still 12 billion short per year to do this. Yeah. At some point, the growth does taper.
Yes. Agreed. Do I think they're going to collect $300 billion in orders from OpenAI? Absolutely not. There I'll say. I don't think that turns in all of that. I think they've got a business. I think they'll get more revenue from OpenAI. Do I think the full last $300 billion will be wired in 5 or 6 years? No. I very much doubt it. But
is this market not just all about shouting as loudly as possible? Do you remember Stargate? We're going to have $500 billion. What happened to that $500 billion? Seems like there's a lot of... Can I
ask a really cynical question? Isn't this one of those where everybody just announces the same thing? So yeah, it used to be what SoftBank But wasn't Oracle part of that? And maybe now this is
Larry was right. It did happen. This is a big part of it.
This is Stargate. This is Stargate.
Honestly, to me, it's a reminder, we've talked about this, to really scrutinize Sam to see the future, because he goes to Trump, right? And he's got Sun from SoftBank and Larry Ellison in that awkward photo. Musk wasn't there when he was still running things, right? This was a couple months ago. Announcing the Stargate thing, I'm looking, what's this uncomfortable Larry Ellison who hasn't put on this, doesn't look like he's put on a suit in 7 or 8 years, sitting there squirming in the White House. This was, we should have bought Oracle stock that day. Like, why we didn't put the whole fund into Oracle because why did Sam make him come? Right? I mean, we got to do this, right? That was a telling moment to me, but I didn't get it at the time. This just seemed like the oddest photo op. And it seemed like dissing Elon Musk, but it wasn't that at all, right? This was the future.
I mean, I think one of the things that's obvious from this is that everyone is getting what they want from this press release, right? Oracle is becoming the richest man in the world because his stock's going up 37%. Sam Altman is getting, frankly, leverage in his negotiations with Microsoft by making it clear he has another CapEx provider willing to spend vast amounts of money. So to some extent, this is happening because everyone involved wants it to so. And I'm willing to bet they want it enough that they're not sitting there going, are we 100% sure this is going to happen? Or do we just have a credible case that says this might happen and it will be good for us in the short term? And look, to be fair, especially when you're trying to do something as ambitious as OpenAI, to some extent, momentum is your friend. And momentum is a necessity. And things like this just keep building on the momentum and keep building on the sense of inevitability. And you're right, Harry, it's the role of investors to be a little more cynical and scrutinize and say, do I really believe that that's going to turn into $60 billion a year of revenue? Should I really mark Oracle up by that amount? And clearly they forgot to do that this week.
This may be a broader point, but I just feel like the whole venture landscape's just moved from a game of investing to trading, in a way that we're all just hoping that someone pays a more irrational price than we paid and suspend disbelief in the meantime.
Yes. Well, I think we still have a couple good years until something happens. So might as well play the game.
Are you going to be the Chuck Prince of our generation? Remember, while the band keeps playing, you got to keep dancing, the CEO of Citicorp in 2007. Jason, you might regret that quote. But you're right.
No, I think you got to play.
I've kept dancing with Hopin, Be Real, and Clubhouse, and you know what? The party stops. I'd rather stop.
But what happens along the way is there's exits. So I think the big question for venture, I think where we're going to make a lot of mistakes in venture, is not taking billion-dollar exits over the next 24 to 36 months. We're going to triple down. There's going to be board members. Rory, I know we've got a $4 billion offer for our latest AI tagging categorization software at 3% gross margins. I want 8 or 12 would be better. You know what's better than 12? 24. And we're going to say no to those fund returners, and we're going to wake up and they're going to be worthless. I think that's what's going to happen. It's because if you're in the game now, you got to have a couple big exits and IPOs the next couple of years, or quit the game. You got to have a couple.
First of all, you are right that will invariably happen. I mean, we're just at that stage in the cycle where you've got a large amount of euphoria, fairly untethered. And, the positive spin, which I think is true, is you don't make these kind of technological leaps and technological investments without a fair amount of accompanying euphoria. This is a means to the end of moving the needle forward on AI, right? We got to try a lot of stuff. A small amount of it will work. A large amount of it will fail, and a lot of money will be lost in the end. But the good stuff will ultimately outweigh the bad stuff. This is the way it happens. But to Jason, your point in particular, I'm around long enough. I remember a bunch of those companies in 99, 2000, right? Where, you got the offer for $2 billion for some fiber optics company or for some comm equipment box. And the board said, damn it, we want 8. We're turning it down. And then you'd meet the team 2 years later and the company was worth 0. And most of those folks were shell shocked. It's like, winning the lottery and then losing your ticket. It was brutal. Right. So I think being canny and shrewd about what chips you take off the table in the next couple of years, I think you're exactly right, Jason, would be a key part of the game.
I also think people mistake valuation for liquidity, which is like, just because it goes up doesn't mean you can get out. And if you can get out, it's often at a discount to that price round. And if you can, it's often in a strip where they'll give you 10 or 20%, but you can't get out as much as you could selling it all now for 4. I don't think people think about that enough.
True. And I think one of the things we're going to discover is when all this action was happening in the public markets, you had this weird, somewhat positive phenomenon, which is everyone up with constant liquidity, right? You know, you can buy in it, $80 a share, it goes down to 70, and you can say, I was wrong, I'm out. And someone else thinks, I think it's going to be okay at 70, and they go out and they're wrong, and it goes to 60. And you can kind of parse out the pain among various investors who come in and out of the stock. The interesting thing on the private side is you've bought in high, and the whole point of private is there is no meaningful liquidity. And if you're wrong, you're going to own it all the way down. It's going to be a lot more fun on the upside and a lot more pain on the downside when you don't have liquidity to fulfill the part of the role of liquidity is allow you to alleviate risk. That's just the game we're in, and that's just the nature of being private for longer. Bigger bets,
every
bigger
single
upside,
founder that this year that has had a strong M&A offer, I've told them to take it 100% of the time. Now, I actually don't necessarily want them to take it, but I want to be the guy. I don't want to be the guy saying I want to double down and quadruple down. I don't want to be the guy that a couple of years later, it didn't work out. So I'm telling them to take it. And if they come back and say, no, I'm confident. Here's my new heuristic. It's so simple. No, Rory, I'm confident we'll be worth 10 times as much. No, I'm confident we will IPO. I'm confident, like Kaz just left hundreds of millions of dollars behind at Shopify. Okay. Right or wrong, that dude's confident. We just heard it, right? He knows. Now, it's not all about the money. Okay. But he's confident this was the right decision. But I'm telling the opposite. I'm telling every founder, take it. Take any massive offer, take it. And I want them to come back and say, F no way. It's going to be bigger. I don't want to have any of those regrets. And I think it's the right. And I also think telling them to do that, make sure that I don't screw it up as a GP, right? It's just so easy when times are good to say, oh, Oracle's going to get another 500 billion, aren't they?
Totally. And, I would say, like, I don't love your sentence, but I actually think it's right. Your advice should at some extent be tempered by the time, right? The presumptive, the Bayesian prior at a time like this when valuations are at an all-time high should be some version of what Jason said. Now, it's still possible that you're the 1 in 10 for whom, an all-time high is just a step on the journey. And, maybe you should play the game out because you're so confident it's going to be amazing. But you're right. Most of the time, I mean, look, it's very noticeable that 3 or 4 times in the last year, you've seen significant M&A driven by founders at the same price that VCs either had just invested or were about to invest, right? In other words, that's the founder saying, because the VC member is investing thinking, oh, you're worth $2 billion. I'm going to give you money at $2 billion. I think you'll be worth $6 billion. And then 3 weeks later, the founder is saying, you mean I can actually get the $2 billion? I'm out of here. Right? I mean, to some extent that happened at Scale AI. I think there was a pending offer on Windsurf. And that's founders, Jason, maybe listening to you and being shrewd and saying, I could be in a local maximum here. This is a good time to take the chips off the table. And there's a little bit of information in that about how much, dare I say it, more shrewd they are about the value of the asset than the investor who was about to write a check at the same price.
I completely agree. I also think it goes back to incentives and how investors, to what we said last week with Jeff, have many options and, we want to ride them as much as possible, and founders have one and it's their whole net worth in it. And that drives a lot of decision making, I'm sure, tied to that. I do want to be cognizant in terms of how we discuss the topics we have on the agenda. We mentioned Oracle and OpenAI. Microsoft and OpenAI's relationship is slightly changing, it would seem. Announcement of Jason, why don't you give a snippet on what this is in terms of the news between their relationship and how it's changing?
We have more to learn. It is, it's going to be interesting. I mean, Microsoft, I think today said they're moving not just parts of Office to Anthropic, but that it is the default choice for several other products. And that Microsoft today said several months ago, they told their teams to start using Claude Code several months ago. So they've been breaking up at some level for a while. And I guess it's fine. I mean, I guess it sounds like We don't know maybe Rory knows the detail of the deals. I guess it sounds like OpenAI is going to get some of what they want. They're going to get this revenue share reduced. They're going to get their freedom to partner with whoever they want. And I'm not quite sure what the price in blood is going to be back the other way. But already Microsoft's moving on, right? They're already moving on. They got the IP. They're going to keep the IP, I guess, right? That they're going to keep whatever IP they're allowed before AGI. So they've got all the code if they want to do anything with it. And they've already moved on to Anthropic, which is good because I think ChatGPT is probably going to end up being almost as good for coding as Anthropic. So the whole thing, the shifting sands of AI, it's a lot to process.
Yeah, it is. And it's worth pointing out, it's some kind of interim MOU. It's not a final done deal. I think it's both sides saying we're making progress here where we're ending up. But you're right, Jason, it's that this is a moving on. This is, consciously uncoupling here, right? Because if you look at it, what the end game is some version of Microsoft. Because OpenAI had this weird structure, for reasons we all understand, Microsoft ended up with this weird investment that, in my view, gave them a fair amount of blocking rights in a lot of different ways. It gave them access to the, 49% of all the profits to a certain amount. It had, rev share. It had a lot of things that was effectively a bit of a poison chalice for OpenAI in terms of making it a real, proper, standalone company, right? And what's clearly happening now is it was a marriage of convenience for a while. Both parties are moving apart, right? And the rational, I'm not sure where it ends up, but the rational end game for Microsoft is we got something along the way, but we don't need the model. We don't just need the model anymore. Anthropic looks to be more useful for this. We still have access to their model. We like that, but we can buy that on a third party basis. Just give them money, be a customer of the model. We got some lift from AI in the short term. We have some business with them as a hosting provider for Azure. All those are good things. But in the end, my guess is they convert that $13 billion investment from a blocking kind of thing to a, pick a number between 20 and 30, 35% ownership stake in OpenAI. And, if OpenAI is worth $500 million, Microsoft will have put in 12 billion and probably be worth 100 to 150 billion. It's a 10x venture return on 12 billion. In one sense, it's a great return. But as you guys know, we've talked about this, it doesn't move the needle when your market cap is 3 trillion. You don't get paid as a large market cap company for making, oddly enough, $100 billion because it's like you've got a 3 billion market cap. It doesn't move the needle, right? So when you zoom out 3 or 4 years, I think the conclusion will be, wow, that was an interesting investment. We got a kind of bit of a lift from Microsoft perspective. We made a lot of money, but doesn't move the needle. We got some buzz on AI in the short term, but we didn't really get what we wanted, and we don't have what we need in terms of AI, and we probably got to keep cranking on that.
3 years' time, how do you think the relationship will look between OpenAI and Microsoft, and then Amazon and Anthropic, the pairings that we've seen so far?
I think it's clear that Microsoft will be a large shareholder, hopefully OpenAI for them will be both a customer and a vendor because they will be selling cloud capacity to OpenAI, but not on an exclusive basis. They will be buying from OpenAI access to the models, but probably not on an exclusive basis because they'll be all moving Anthropic. So in other words, a perfectly normal relationship between the largest software company on the planet and this entity that they help form, found, and start, but where, it's now grown up, it's left the house, they're no longer dependent, and it's just a perfectly fine arm's length relationship with a massive equity ownership that's probably going to make them $100 billion to $200 billion, which is a lot, let me repeat, which is a lot for anyone else, but still the real value to Microsoft has been the lift in its perceived market cap, and its actual market cap from the perceived AI buzz in this 2 years where frankly they had nothing. And I think the real question will be to put the heat back on the Microsoft team, the real question will be when OpenAI finally pulls away and you can't rely on not bullying, when you can't rely on your complex agreement with them to get access to the AI you want. Have you built your own AI that matters? Have you done something? And if you have, that's great. And if not, then you missed that market. That's where that one will be. I don't have as good a sense on Anthropic and Amazon. I'm not as close to it. I'm not as informed on it, maybe. I'm not close to either, but my guess is much the same. Often when a big company partners with a small company, the small company gets smothered. In both these cases, the small company won. They got the money, they got the critical mass, they got the credibility, and now they've pulled away. And neither Anthropic nor OpenAI needs Microsoft or Amazon at this point. They don't need them for money. They don't need it for because the industry will give them infinite money. They don't need them for compute because Larry will give them infinite compute in return for money. They don't even need it for distribution. So in fact, both these companies, ironically, just like Microsoft 30 years ago used IBM and then left them, an empty husk, I would argue Anthropic and OpenAI have used their large corporate relationships, gotten the value out of them. It's still a bit sticky because the agreement's weird, but fundamentally they've made it. They're independent, standalone companies. Thanks for your help, guys. Here's your equity position. Call me for the IPO.
And Rory, thanks to your description of an empty husk that was Scale AI, I had them in my inbox this week asking to come on the show and tell us why they're not an empty husk. So thank you for that. That'll be coming to a 20VC soon, which should be an interesting one. I do want to discuss.
We all did think that for a long time when it was a weird deal. It was, Microsoft buying 49% in essence of OpenAI was the first of those deals, right? Those style deals, the Scale, Windsurf. But it didn't turn out that way. They didn't leave a husk, right? There were some superficial similarities, but in the end, we all thought, in fact, probably the first time we did the show, we probably might have still said that Microsoft basically acquired OpenAI. It was an acquisition in disguise, as it's turned out not to be the case, not remotely the case, right? Kudos to Sam Altman for dancing his way out of one of the greatest bear hugs of all time. He was basically had to sell his company to Microsoft to get it off the ground. And now he's going to get out of it. He's going to get out of it. Like, wow.
No, you're exactly right in a way that the others, and that's because when the founder goes with the acquirer, it's a bear hug. It's an empty hug. It's an empty husk. When the founder stays independent like Sam, stunning win. I think you're exactly right, Jason. That is it is Paul Graham. You got to give him credit. Said it. You could put him on an island with a bunch of cannibals and he'd be king. Well, you put him on a plane to Seattle and he came back with a bunch of money and now he's king.
This is what I find funny. We go back to the Oracle and the OpenAI skeptics and I'm like, fuck it. I'm not betting against him.
He might find he might find some of that money. Do I think Oracle will book a fair amount of cloud compute from OpenAI? Absolutely. Maybe not 300 billion, but if he's willing to provide it at a lower price than Microsoft, my guess is those fine people at OpenAI will take it.
Another thing because we had Kaz here, right, with his leaving 200 and something million behind. It's another thing when you have post-economic people, it's difficult to fully predict the outcomes of these things, right? So not only did Sam not leave the husk, right, but his ability to have no equity in OpenAI, Microsoft couldn't pay him enough to move over to dehuskify because he had no equity to husk, right? Kaz may make $1 billion. Harry was kind. His job is to make $1 billion from Opendoor, right? But even risk and time adjusted, leaving 200 million behind at Shopify and another 70 something million in grants and what he might still get, you could only do that if you're post-economic, right? I hate it. I especially hate it when some guy that was a senior marketer at some company and spun out with a couple $1 million tells everyone he's post-economic. But Sam and Kaz are taking post-economic actions. And it's very interesting in today's world where a couple billion isn't very much.
I don't
in market cap, in valuation, not in personal income. A couple $1 billion seed round, it's barely going to make Terry's show.
We're going to dive into kind of the application layer, and two that Jason is passionate about, and I'm really excited for this actually, is one is Higgsfield and the other's Replit. Jason, which one do you want to start with there?
Either one, man. Depends what you want to talk about. I think there is one thread. There's like this Higgsfield gamma thread, right? And I just think it's somewhat interesting that both are slightly under the radar. The CEO of Higgsfield was not quite complaining, but sort of shouting this week, right? When he did around that, hey, he's gotten in revenue and certainly in users gotten there even faster than Lovable and Friends, right? Doing quick video. I'm a small investor. I've been a user since it launched. I mean, I love Higgsfield. And Gamma at 60 million this year. Gamma at 60 million, from like 0 to 60 million this year. That's pretty good for slides.
Just to be clear, Higgsfield is a AI video creation company that raised $50 million and also announced $50 million in ARR in a faster time frame than Lovable and Replit.
Yes, and maybe Gamma's close too, right? I mean, we could talk about Higgsfield's under the radar if you're not a creator or using the app. Gamma, maybe folks on this pod have used it more often, so under the radar. I guess we could talk about that. My meta point is, my God, right? If you don't see some of these numbers, it's not just Cursor and Friends and Replit, which we could talk about. I mean, who would have thought that listen, going back to Kaz, homes are a big market, restaurants are a big market, like Shopify, but like sometimes we don't even realize that like short video and slides are massive, just massive. And that Higgsfield can do this in the shadow of Google, even though they're using Google models, that they can do it in the shadow of so much competition. It's just, this is why it's so hard to do a triple, double. It's not just Lovable. There's so many Lovables. There might be 20 or 30 Lovables.
And I think what you're seeing, I mean, stepping back, right? What you're seeing here is that with AI, there's a series of things that quote unquote ordinary people couldn't do before, be it coding or be it video creation. And these tools are making it accessible to everyone. So you have this, because it's very interesting, you have this step function, 10x, maybe 100x increase in accessibility of creativity or coding, right? And that's the positive momentum. And then the negative momentum on all these deals, the Replits, the Higgsfield is, oh my God, you don't control the underlying model. If you don't get enough space, will you have churn? There's a lot of risks on those deals, but sometimes it pays to zoom out to the big picture. The big picture is anyone with internet access today can create cute videos, can edit videos, can be creative in a way that 5 years ago you couldn't do unless you were unless you were a trained special effects editor. And that's huge.
Maybe 7 months ago. It's your right point. But you couldn't do these things. And now you can do it for pennies. It's beyond disruptive, right? And
anytime you're dealing with shit that everyone can do, you have the potential for these exploding growth rates. And you guys are living it with Replit and Lovable in coding. And I think Higgs is an example of that in creativity. And I think there's going to be more of them.
Sometimes I'm just shocked by the venture. Like sometimes I would look at some of these things. Like I'd be like, we use GAM all the time. I love it. Right. I love it. But I'd be like, how the hell could that get to 60 million in this year? It's like, do we really make enough slides? But to Rory's point, it's a way to create content you could not do before AI. So I get it, but it's just so many of these markets are bigger in the age of AI than they were pre-AI. I know it's Captain Obvious, but Higgsfield for short videos and Gamma for slides. I even like Opus Clip was like the first little AI investment I did. Like I got it, but I didn't think it could add up to so much revenue to make these clips. Right. But, it's just, you got to get the spreadsheets right. You can't use the TAM spreadsheets from 2021.
I find this time a little bit like COVID though, in terms of market forecasting, which is a real difficulty in understanding what is a sustainable market trend that will be meaningful and enduring versus what is an experimental market that is cool to create, but ultimately whimsical and doesn't last a cycle. And I'm finding that uncertainty very challenging as an investor, to be quite honest.
But the thing is, like, we agree, but like that conversation we've been having since the beginning of AI, and a lot of thin wrapper apps died for that reason, right? But what we are seeing, it's a valid concern for venture, but we are seeing at least is the nominal NRR is pretty high in these apps. So it may still crash and burn, don't get me wrong, right? But if you're using Higgsfield and Gammable and Lovable and Replit and you're seeing triple digit NRR, even if it's not the NRR we used to talk about for B2B, it's hard to say no as a VC, isn't it? It's hard to say no when you see 140, 180% revenue. You can say no and just sit at home and knit.
I don't know, dude. When the margins are where the margins are, you have to project out and go.
But Higgsfield is profitable, is cash flow positive. It varies based on the application.
It varies based on the
they're not all Replit and lovable with negative margins. They're not. But it's a fair. It's just, I guess my learning is it's like they're all over the place. What the margins are, right? They're all over the place.
Agreed.
Right.
And you're right. I mean, Harry, again, yeah, it's hard. You've got to figure out which exploding growth company is going to be sustainable and which exploding growth company is not. But at least you're dealing with the problem of exploding growth companies, right? And, right?
Yes, but I'm an investor in a business, Airwallex.
Yeah.
Very similar businesses like Stripe. This is a unwaveringly enduring, growing, strong market. Fantastic. Comparatively, these others are incredibly experimental, potentially groundbreaking, and potentially whimsical. Very different.
Well, you got to be able to tolerate a loss ratio, if nothing else.
Yeah, they are different.
You got to be able to tolerate 30 to 40% of losing your money on it.
They are very different. And, and I'm not naturally good at these creative deals because I'm just not naturally, I get all your points. It's my, and I tend to be the steady compounders. But I think different deals have different attributes. And, again, think about it from a portfolio. You've got to look at these and go, some of these you will be flashes in the pan, but so the question is, what's the distinguishing characteristic of the companies that explode and then sustain, right? And my gut, I'm kind of riffing here and we can talk about it. It's probably two things. It's probably having expansive white space that you can grow into, which your customers is, more things you can do versus getting cut off shortly. And then secondly, having a founder who's maniacally focused on doubling down and adding all the rest of the stuff. And something you guys said about Lovable and Replit a while back stuck with me, which is you can envisage a whole bunch of ancillary products around that. So as people build their websites, all the other things it takes to make that website work, and you can envisage building an economic model around the combined thing. Right. So I think it's a combination of the opportunity. I think some of these things will be flashes in the pan, to use, I'm not trying to be mean, but to use the hop in COVID, right? It will be a temporary phenomenon. It goes away. But finding the ones where you have that explosive growth and then can parlay it into enduring is going to be pretty damn interesting.
We've never seen competition like today. Never. You used to have 6 months, maybe 12 months. You'd launch something. Your competitor would kind of look at it, decide if it was worth their time to build it, commit to trying it, then 6 months later get it. But you had a full year. Now you have like 2 weeks.
Everyone complains about competition and everyone's prepared to do anything to solve the problem except the one thing that will solve the problem, which is step away from the table yourself, Harry. So we've got too much competition, but you're not quitting. I'm not quitting. Yeah, I mean, tough luck. It turns out, it's a very competitive time up and down the stack. It would be a lot easier if there was half the number of people, but the opportunities are compelling and, people are going to show up and try and play.
But look, let's take an extreme example. Like I could imagine, I don't think this is going to happen, but it's not impossible. Anthropic could lose half their revenue in the next 12 months because GTP5 codecs might be just as good. They could lose half of it. Like literally all you do is turn it on in Cursor or Lovable or Replit or a million other apps or, whoever, Higgsfield or Gamma moves over to GTP5 codecs instead. And if GTP5 codecs is as good as Claude Code, which it just launched, I could imagine it is 95% as good. You could imagine in today's crazy world, Anthropic could lose 30 or 40% of its Claude Code revenue in 1 year. It's very imaginable. I'm not saying it's going to happen. But the switch, it could happen. Even that may not be stable. Going to Harry's point, forget about whether Lovable and Replit and Base 44 are stable. I'm not even sure Claude Code's stable.
And to state the obvious, that would be a very different level of stability than we saw on the SaaS era, where, these things lasted forever. They churned 5%. If you are right, Jason, if it's even 30, 40% probable that something like that could happen, and I don't have a developed opinion yet on it, that's obviously a very different world you live in terms of risk.
Yeah, I think it could be high risk.
The only interesting take I'll take is that I interview honestly 3 to 4 Decacorn CEOs every week, and on this topic, 2 interesting elements: completely price insensitive as to how much they spend on Anthropic and Claude Code in particular. I would spend 10x. Don't even look at the line item. Number one, but at the same time,
these are the hyper growers. What about Cliff at Canva, who just said on this show he's super sensitive to it?
Just let me roll with this, but apologies. Then second, this duality of like super low switching costs and a complete awareness that actually they would very happily move tomorrow to someone else if it were a comparable service.
Which goes to explain the urgency around CapEx for these companies, because their belief, and so far it's been correct, is that the only way to quote, if you're competing with Claude Code, all you know is the only way to outperform is more reinforcement learning, more pre-training, more whatever, which means more CapEx, hence the quote insatiable demand around CapEx, because it's the only way to win. All the players are being rational in the game, but you can see it adding up to something pretty scary.
Kind of bringing this all together, the Higgsfields, the Replits, the thing that could also kill them is actually the fact that Wix has base 44, which is actually doing incredibly well. The fact that Adobe or Canva could do what Higgsfield does, and with the existing distribution they have, do it. Going to the distribution and going to the incumbent versus startup, how are we thinking about incumbent versus startup and the core crux there?
The market would say that the Wix acquisition has worked very well, and it's probably going to be 50 million in ARR by the end of the year, so that's a win. The market would also say, just based on the thing that Adobe and, let's be honest, Salesforce aren't seeing that have tried to announce AI products and have gotten some traction, but aren't able to access that explosive growth. And I think market reaction to the Adobe stock price kind of reinforces that. So it's not a kind of simple binary answer. It's some folks have pulled it off, and probably in fact, as I think of it in real time, because it's easier for 100 million to make a difference at Wix than it is to make a difference at Adobe or Salesforce, 23 billion in the case of Adobe and 40 something in the case of Salesforce, where it's hard for those incumbents to move the needle significantly, which is why the stock prices have been down, because you're not getting the AI explosion.
Yeah, but I think for sure. But I think to me, the base 44 Wix thing is interesting because we've been asking for a while, can the incumbents benefit from AI the same way the startups have, right? And we're looking at ServiceNow kind of faking it, right? And we had Mark Benioff, who we all love, but we're not seeing it in the numbers yet, right? And we see Palantir, but Palantir is a completely different company that is AI first. So we're not seeing and we're seeing it in our own portfolios. We're seeing a lot of our 2021 high flyers not exactly crushing it in the age of AI. There's the Dialpads, the Talkdesk, there's the others that have, but a lot haven't. But what's interesting, then you see Wix come in and they buy a little lovable Replit clone that is just a cheap clone by one guy. I mean, kudos to him, right? Solo founder, right? Bought for 80 million using the same underlying technology, Claude Code, right? But they bolt on what Wix is good at, which is safety and identity. Okay. And then they bolt on the friggin' funnel. They push it out to their base. And if that's nothing to 50 million in a single digit number of months, imagine it's 250 million. And more importantly, for the numbers, to Rory's point, if it's 10% market share, that's a lot for a big company distribution to get in a couple months, 10% market share. So if Adobe could do that, if Figma could do it, right? If Figma can do it with its thing, could it be revenge of the incumbent? I don't see much evidence, but I like the base 44 as one example of the revenge of the incumbent, right? I don't want all of our friends to go down into irrelevance. I want to see Zoom back. I want to see everybody come back and be roaring in the AI age, right? Not just the new guys.
I mean, speaking of like incumbent and innovating as an incumbent, while we've been on this, I've been sent by a lot of people Workday acquiring Sana Labs for $1.1 billion. Wow. They were at like 50 in ARR. There's a pretty great outcome for everyone involved. $1.1 billion to Workday. First, I think Sana's great, Joel's great, but this was a second to Glean, very much so. Wow.
But you know, in these times, being number two can be a great place for M&A.
Yeah, absolutely.
When number one is unacquirable, you get so many offers, right? I wish I'd realized that as a founder, right? I mean, knowing Rory, like even if EchoSign had just done okay and we'd gotten up to 100 million, just the folks that DocuSign turned down would have come and bought us for $1 billion. Like I wouldn't have had to do anything just being number two. I would have just had to open the email and sold for $1 billion at a moment in time. Like today, it wouldn't have worked, right? So today is in the age of AI, you can't buy. Glean's unsellable, unacquirable, right? Lovable's unacquirable, Replit's unacquirable. So being number two for venture, and the other thing in frothy times, they'll pay up too.
Agreed.
They'll pay 2 times, 3 times what they would have paid otherwise. So number two is great when number one's not available. Just don't raise too much if you're number two. Don't make yourself unacquirable.
Can I push your thinking? Is number one really unacquirable when Scale gets bought for $14.9 billion? Are we not seeing the limits pushed for what is acquirable and what is not?
Yeah, but it's got to be a hyperscaler or someone.
Agreed.
Like Workday can only pay so much, Harry. Workday cannot pay $26 million to buy Glean. What's Workday's market cap today? Right? It just doesn't have the capital to make all the VCs what they want.
Agreed.
I'm not saying you're I think everybody's right? For sure the hyperscalers can pay up, but also a lot of folks won't sell at any price. And so being number two, just as founders, it's a cheat code. Like just don't raise too much, be acquirable if you're number two, be kind. Right. And you will be shocked in frothy times the offers you'll get. You'll be shocked the offers you get being number two. You'll be shocked.
Have you ever regretted selling, both of you?
I'm pausing and thinking. Yes, there are times when
A friend of mine said to me this week, Harry, I've never regretted selling and making millions of dollars.
As a founder or VC, though, that's different questions as a founder versus VC.
He's a VC.
Listen, I mean, Rory might have more, like in my experience as a founder, I would say more than 51% of founders regret it. I regret it. But as a VC, like, here's the hubris in this. The hubris in this. You're going to tell a founder she or he can't sell and expect them to work twice as hard after you tell them to F off. At the end of the day, unless you're a total douche, if the founder wants to sell, you sell. It's not your decision. It's not your decision. That's the height of hubris in my experience.
Agreed. And I don't think you even do tell them. I mean, you asked me, do I regret it? It's like, there have been times when I look back and I go, oh, I think if we'd held, we would have compounded and been bigger. And you have objective facts that make you believe that, which still isn't the same as saying you regret selling. In fact, in that particular, one of the cases, I'm choosing my words, because in case my dear friend who is relevant to us listening, I talked to the CEO 3 or 4 years later. And I said, oh, look, our competitor is now worth, 4x what we're worth. Do you regret it? And he wisely said, no, I took money off the table. I bought a house. I got married. I've got kids. I'm wildly happy. I'm doing another deal. Here you want to invest. Here's the terms. And my life is great. So as an objective matter of fact, you kind of go, compounding would have been good in that case, but it wasn't to be. And I don't regret it vehemently. I'm just like, yeah, most of the time, I'm just trying to think. There's only a few where you look back and go, there was a lot more compounding in it. A lot of the time you go, yeah, that was a good call. And again, I think the more salient fact is this, Jason Wright, is if the founder calls. So my MO is actually very different. My perspective is not have an agenda one way or the other. Well, the first thing I always say to founders is, if the liquidity window opens as a private company, you should pause and take it seriously, because most of the time it's not open. So the mere fact that it's open, you have to pause and think. You have to change your game from, you're 90% heads down, work hard, and now someone's made an offer. It's now time to get real and figure out.
Or do you not have to apply that same mindset as an investor?
You do.
With secondary market. Yeah.
You do, but I'm saying for the founder, it's more significant because it's all or nothing. You can get it all off the table. And then you have the real how do you feel about things? As I always say to them, now would be a good time to voice any of those concerns that you've been suppressing deep in your, sternum here, guys. And
Rory, are you having active partnership discussions about much more liquid secondary markets and a trader mindset of maybe selling in a way that you wouldn't have done years before because secondaries are available?
They are, but the truth is that except for, I think they're available, but they're not as, there's a small number of companies for whom they're easily available at a discount. And there's a much larger number of companies that, where you have your winners and you look at it and you go, I don't know if the market fully appreciated what's this worth yet. I think I'm probably a holder here. So I've no vestigial attachment I have no reluctance to sell. The opportunities, again, it's a little like the founder window opening. Everyone likes to talk about this. LPs like to ask about this. But the truth is, the number of times that as an individual investor, you're in a company that's so freaking amazing that there's a free liquid secondary market where you're in early enough that you have a big enough hit to move the difference. It's low. If you have one of those per fund, you're doing great. You probably have 3 or 4 winners per fund, and only one of those is kind of that super marquee, amazing one, right? And then did you buy, the people who bought in at 50 billion at Stripe aren't looking to sell at 90 billion just because it's liquid. Conversely, the people who bought in under $1 billion probably are and should. So my point is this: yes, you have these conversations. It's not like you spend most of the day you're out there trying to keep your $10 million AR company, help it go and get it funded and hope it doubles.
And that's a new world. Like that, getting those funded is harder than ever when they're going from 10 to 20, but that's an entirely new discussion. Speaking of moments of liquidity, IPOs. We had a $3.5 billion IPO for VIA. We had Gemini go out at $4.4 billion and 32% bump on the first day. And then we had Figure Technology raising close to $800 million in their IPO. Gosh, how exciting and nice to have IPOs again. Which do you think is most interesting to discuss out of those?
Well, can I add one thing? And Rory will know. The busiest IPO week since 2021 isn't to be ignored or taken lightly. Now, it isn't the busiest year yet. It could end up. It's already September. Next year might be as big as 2021. But getting back, if you've ever been a founder, worked with a company that's decelerated, getting back to where you were is a big moment in time. Like, you should celebrate when you got back. So last week we were back to 2021 for a week. Maybe we'll get there for a month, right? And then you get there for a year. It's a big micro milestone to have a 1 week of 2021.
I think they're all interesting for different things. I think Figure is the most interesting, just to start with that. So let's look at it. And again, setting the scene, looking at those 3 IPOs, 2 of them are vaguely crypto related, Figure and Gemini. One of them is kind of a very not niche, that's not the right word, different SaaS, primarily a SaaS company selling to governments around transport, has a lot of complexity, and it's not just SaaS. That understates the complexity of the business, the VIA business. But the other 2, and then, so of the 2 crypto companies, Gemini is the Winklevoss twins, of, social network repute. And Figure is Mike Cagney, who was the founder of SoFi. So the first thing you note here, there's 3 IPOs. 2 of them are kind of second-time founders, depending on how you adjudicate the Winklevoss case. So the F. Scott Fitzgerald line that there are no second acts in American lives is wrong. These are 2 out of 3 are second acts. Cagney's interesting because SoFi, I think it's an interesting company. Both the IPO, SoFi was an interesting company, very differentiated, has gone on to be Tremat's only successful SPAC. And, a perfectly great, successful public company. And what Figure is doing is using the blockchain as a settlement mechanism for home equity loans and other kind of non-conforming loans. So at heart, it's a financial services company. It's a fintech play. It's lending money, which is one of the core things fintechs have done for 2,000 years. But its interesting twist is it's using the blockchain to process the back office more efficiently. In the end, it won't, it'll rise and fall based on credit. If you make bad loans, you lose money in the lending business. But there is an interesting twist around using the blockchain to instantly settle these loans, to be able to securitize them. There's some kind of securities law issues. But interesting company, clever, good twist on blockchain. Fine. First of all, yay everyone. Finally, a use for the frickin' blockchain that's standalone and independent of its kind of a trading asset. So that's what Mike Cagney's done here, and all credit to him. It's a good company to stock, popped nicely, right? So everything about that one to me is the most interesting. Gemini, it popped high and then dropped down fast. It was fun. All three stocks behave very differently. So even at the, trivial level of the trading, Figure performed perfectly. Gemini popped way up and then intraday came way back down, right? Revenue's declining on that one. It's another crypto exchange. I never can tell them apart. It's just not Coinbase and not, whatever the Binance is. So I don't know why it matters. Revenue's declining, but, God bless those guys. They've hung out it a long time. And then interestingly, from a stock price performance, VIA actually opened below the trading, below its offer price and then bounced up during the course of the day, proving that it's not always free money to buy at the stock price. But yeah, so fun week for stocks, but definitely to me, Figure the most like, oh, that's interesting. I'd like to learn more.
I guess the interesting question in the age of AI with VIA Transportation, right? So founded 2012, so that's 13 years, right? Classic B2B plus. It's not just SaaS, but B2B plus. $493 million invested, $4.2 billion valuation, will fluctuate. So 12 years so that the investors in the aggregate 10x the total capital invested. That was a A plus, but not S tier investment until 18 months ago. Is it good enough today? 13 years, 500 in, 4 point something billion out. That was great until recently.
I would take it in a heartbeat.
Harry's not sure. He's not sure if he likes the fact that it has a defensible platform, big enterprise customers, or does he want to put more into Lovable? He's just not sure which one he wants to do. They're both have pros and cons. He's doing both, actually.
I think at the end of the day, I'm thrilled to see IPO markets open. I'm thrilled to see exuberance. I'm aware that it will take 12 months for people to truly get cash back, but I am a incredibly selfish, self-centered individual who wants LPs to have more money to put back into venture, and that will align perfectly with my fundraising cycles. And so, inshallah, bring home some IPOs, previous generation, and fill up the LPs funding because we're coming for it.
Good to know, Howie. Good to know. And yeah, it was a good week.
That's how I felt. I was very excited for one, though, which was Bending Spoons buying Vimeo. You Americans, you love to always claim the dominance over Europe and technology. The Italian, buying the public American company for $1.38 billion.
First of all, stepping back, Bending Spoons is a quirky name, but a wildly successful buyout shop that specialize in these old assets that have some kind of brand recognition, but no obvious model. The most obvious one being Evernote, which they bought and have, streamlined, raised prices on, and I believe gotten it to, a more profitable business model. So yeah, it appears to be, probably a successful formula.
I think the interesting thing for me is like they tend to buy assets very cheap.
Yes.
Centralize and just eke out the profits. Vimeo, I don't know how cheap it is at $1.4 billion. Like StreamYard, they bought pretty cheap. Evernote, they bought pretty cheap. And to eke out that was much easier. At a $1.4 billion entry, you're moving to a different scale of entry price that you're moving into. That's a different game of roll-up.
I just have an emotional attachment to the brand. As a creator, I've been using Vimeo since the beginning, right? Since when it competed with YouTube. So that's a smaller portion of the business. But it's $420 million business that's basically flat. It's an annuity, right? And they're buying it for then what? 3 times revenue? Less, 2.5 times revenue. So either they have to make it more profitable, right? Or they have to apply some folks that care more in software to inject a modest amount of growth in a time where Higgsfield and Gamma, will do a third of their revenue in 12 months. Inject a little of that Higgsfield and Gamma love, and maybe they can do it. Maybe it's not all, although I don't know that they've made people use Evernote more. The Spoons guys, the Spoons brothers.
Right, team. Are we ready for a quick fire? A Kalshi quick fire. Yeah?
Fire away.
This will be great. Rory, you're going to love this, okay? So, we had the main man, Kaz, on the show. Opendoor today is sitting at about, I'm just going to check for accuracy, $9.30 a share today, okay? A stock. Where is it going to be end of year? December 31st. It's 9:30 today. Where's it going to be?
Kaz seemed like a very nice man.
I got 24.
You got 24.
That's my bet. My bet's 24.
He just asked AI, Rory. Do you not know this?
No. I just did the way I do venture investments. I just do a line. This is the beauty to being a late seed investor. Like early seed, you got to squint. Late seed, I since first investment, just draw a line. It's pretty much accurate. The Kaz is pretty damn good. The memers like him as near as I can tell from Twitter. I'm going 24. I don't know what the bet is exactly, but I got 24.
24. Rory?
I think that's somewhere between 9 and 24. I.e., I think it keeps going up. I think it's an extraordinarily hard, and I think this guy is so smart and Keith's talented. They'll make noise, move momentum, and I think in the near end, the stock will appreciate because because you can make the story feel big. I'm just going to say it. I think it's a brutally hard business. And over the next 3 to 5 years, you want to believe in that vision of being able to help people in the most important financial decision of their lives. I just think it's an extraordinarily hard business because there's a huge amount of arcane detail on every house and everything's a special snowflake. So I hope I'm wrong because he seems like a great guy. I just think it's a hard thing to build massive enterprise value in. But
Adobe is getting crushed by the markets, but the revenue is strong, continuing to increase. Will share price be lower or higher in 12 months for Adobe?
Adobe's been growing. It's growing at 10, 12%, right? And the multiple went way up, right? A year and a half ago. I think they convinced everyone AI would be good for them or whatever. Some amazing post-COVID story. They obviously were really high in 21. I want to say, 45-ish PE, high price sales multiple, dipped in post-COVID in 22. And then it came back strong. And all that's happened now is it's reverted back to what it should be. 5 or 6 times revenue. It's a wildly profitable, slow growth. They've done some things in AI, enough to not feel stupid, but not enough to actually move the needle significantly. So it's kind of valued just right. It hasn't crushed. It hasn't fallen. It's just the euphoria has faded away. And now it's, I want to say 5 or 6 times sales, 15 times forward PE, company. I think it's still vulnerable to medium-term disruption from AI, but I don't have oh my God, it's crashing from here. It's just reverted to what it's probably worth.
Roy, higher or lower?
Logically, what I said was that logically my answer to the question has to be no more than 10% higher, because if it grows 10% in sales, it should be 10% higher if it's fairly valued today. But I feel it's a low confidence comment. My point is, the salient one is your narrative, and I've seen the narrative on Twitter, oh my God, Adobe's crashing. The real narrative is Adobe's return to earth. Jason hates that. When I'm boring you guys...
I don't think you believe that the stock that stock price doesn't assume a certain amount of forward growth in its current stock price. I don't believe you believe that.
Yeah, I mean... I think it's been growing.
You don't like the Kalshi. Fair enough. You don't like. I'm betting down. I'm betting down at least 10%. And I'll tell you why if you want my.
Yeah.
2 reasons. One, Scott Belsky leaving, bad sign for AI at Adobe. The guy is not 70. Okay, he's still got the fire. He goes off to be more creative. Give him a couple $100 million like Kaz. Like getting Scott to leave was a big blow. And listen, maybe behind the scenes, I'm exaggerating his influence, but I've worked with a lot of the folks that are still executives today. It's a big loss for Adobe losing him in the AI. And maybe he came up. I'm confident he came up short of what he wanted to accomplish. Right? It's a big company, a lot of ships to move, but you're just at a loss without him. 2, this is my biggest tell of being worried about public companies today. Okay. This is my least favorite metric, even worse than Oracle's margins on its cloud services. AI influenced ARR. Adobe announces 5 billion of AI influenced ARR. You don't have to say this if you have AI ARR, AI influenced ARR. That to me, any public company quoting billions of AI influenced ARR does not believe they will have billions of real ARR. I just think both are a bad sign at the margin, but this is a business that can't be killed, right? It is an enduring business.
Listening to you, Jason, you could be right. There could be a little more deflate in it. It's not going away, but it's 10% growth. It's slowing down. In retrospect, the real comment is how the hell did people think less than 2 years ago that it was worth 18 times revenues when it's worth 6 times today, right? I mean, what were people smoking, right?
Yeah, a lot of Adobe's history is financial engineering and the move to the cloud, and they got a lot of run out of that, right? But in the end, Scott wanted to buy Figma, it didn't happen, and he left.
They did at least try. They weren't let.
They tried.
But yes, just think if they bought it, you'd be getting those little pop-ups from Figma too, telling you, you've used up your license for Figma Adobe Cloud. Please pay $79.99 for the next 12 months. I find the Adobe product to be the most annoying and least understandable set of licensed products out there, right? Which harass.
It's because Jason's not there, Rory.
It's because Jason's
Well, it is because what happens is if you want to know what happens, you sit in a conference room with spreadsheets. Right?
Yeah.
At 11% growth, like Salesforce is probably getting the majority of its growth from price increases today. Like it's hard to parse the numbers, but my rough view of Salesforce with 6 to 7% annual price increases on average, growing 9, it's not, you can't trace it perfectly. Maybe Rory can, but I'm assuming the majority of Salesforce's growth is from price increases. And you're sitting at Adobe at 11, and you can figure out how to get people to accidentally prepay for 3 years or confuse monthly and annual. That could give you hundreds of millions of dollars of revenue, right? And they don't care about the cash. They care about the GAAP recognizable revenue. So they want to lock you in for life at the highest price. And those meetings do happen and they last days. They last days on those things. It is not just one product manager going amok.
I actually think this is an interesting discussion for the last minute here, because you're right, Jason. Like, it's $23 billion in revenue. That's roughly right. And if you compare the Wix thing, right? What does it take? If you don't think AI fundamentally threatens your business here, you're delusional, because it's what we discussed earlier. You're going from a small number of professional creators to an infinitely large number of amateur creators. You've already allowed Canva and Figma to get under your skin, and now you have a whole next generation coming up, right? What do you do that's aggressive enough to move the needle here? Because for Wix, I don't know, doing $1 billion, $2 billion in revenue is $100 million revenue acquisition is, somewhat meaningful. What do you do if you're Adobe, and what do you buy in AI now that you can't buy Figma in pre-AI? And how do you think about the threat here? I mean, they've announced some products, but it just doesn't appear. It doesn't appear to have landed. I mean, one of the areas we've been looking at a lot is that area of next generation creative tools. And, for a while there, I was like, maybe Adobe will land some punches and be relevant. They were talking the right game, but they don't appear to have done so.
Yeah, but Jeff Lawson made the great point, which is obvious, but I think Adobe's in this trap. You can't cannibalize your seats.
Yes.
Adobe wants to add Firefly and AI to your expensive suite, and Microsoft's half giving up on getting people to buy AI Copilot for Office. But what we really want is not even to buy those seats. I don't have to buy a seat with Higgsfield or with Reeve or with Gamma. I don't have to buy a seat at all, right? Or it's just one seat, right? Going to Kaz's point with Shopify, I only need one seat to run my whole freaking store, right? And so there's a triple level of we love the seat, man, but it's tough in the age of AI because you don't want to cannibalize your seat. Jeff's right. It's a tough one for Adobe, right?
Guys, this has been fantastic. The joy for me is you can see the progression of every show, actually, I think. This has been amazing. Thank you so much, as always. And I've loved this.
Rock and roll.